I mean, basically the markets, at least the Dow, has been trading sideways since October 31st of last year.
Hmm.
I mean, you could just set ranges and just see it.
Yeah.
Now, and that's basically the market. Those are the biggest companies, the longest lasting, lower
Yeah.
PE or forward PE, dividend payers, just
Yeah.
solid of the earth companies. And then you look at again market breadth on the S&P and the Nasdaq, and there's still more companies trading under their 50-day SMAs than aren't.
Yeah.
So we're not in a raging bull market where everyone's participating. Not that everybody always does, but a majority normally do. Across segments. And I'm not seeing that. Look at
Hmm.
healthcare now. Healthcare is down, I think, as a sector. Looked at it lately, but it was going down. So when this when Apple breaks, I think that's when you're going to see it.
You think it's
Apple
Apple?
is so much of Apple is so much of everything.
Yeah, well,
You know,
that's true. I mean, it is part of it's one of the bigger ones with the Dow, along with the
no, no,
Microsoft and Salesforce.
right.
Yeah,
I
those are
mean,
the three
Apple,
that,
yeah. So Apple, if Apple goes down, so goes the market.
yeah.
Everybody owns Apple. And, I was watching somebody, maybe it was, I forget, maybe it was Guy Adami, and he was just talking about when the regular public or whoever goes into a S&P index or whatever, or the Qs, they have to buy all this Apple because they're so big. There's so
Hmm.
much of a percent. So anybody that goes into indices are supporting Apple and these other guys that are high. So until that money starts pulling out, that'll hurt Apple too, and all these guys. But it's not happening right now.
Well,
It's
and maybe the cause of that will be the laying off of, people, and they don't contribute to their 401k. I mean, that's where most of the indexes are bought.
right.
Um, so I guess it's a matter of really maybe the catalyst of it is a decline in employment and an incline in unemployment. Um,
Well, definitely unemployment is the last brick that usually falls
yeah,
because right now, if you're a business owner, you might be cutting back on your hours, but not cutting back on your employees necessarily, just to see what's going to happen. But the
yeah.
next shoe to fall is, okay, I'm not getting any orders. I'm gonna have to lay off some people.
Well, did you see China's numbers?
Yeah, they were bad.
Yeah, they're not exporting a lot, which I think is a part of that pie of signs that of strength or weakness in the economy.
Well,
If
look at the credit card debt out
oh
there.
yeah,
Look at how it's growing. Look at the savings rate, which is dropping. No savings, higher credit. People are spending more on their credit cards on food and things they need as opposed to trips and you know big ticket items.
yeah, yeah.
And then they let that credit roll at 20% or whatever higher, and it keeps eating away at them. Plus, you got inflation on top of that, and 65% of the people live paycheck to paycheck. I mean, I just look at these things, and if you think back in the .com, it was kind of the same thing. I don't know if you were around during the .com, but
Yeah.
everything was rosy, and I'm looking around going, how is this rosy? And all
Yeah.
these companies don't make any money, and everyone's it's party time, and boom. So what triggered the .com?
I think it was just probably I forget where interest rates and all that were and what the Fed policy was at that time. But when did 9/11? But that was
Oh no,
01.
Yeah, that's 19. The .com is 91, 92, somewhere there, 90 maybe.
Oh, you mean the move up and the explosion.com.
Well, and then the
The
downturn
downside was,
too. Let me
yeah,
see. When did the .com bubble burst and why did it burst? Thank God for phones.
right? Where was that?
2000 was the stock market crash.
It helped when a majority of the technology startups that raised money and went public folded when capital went dry.
Yeah.
That's
So
what it
yeah.
was.
Yep. Did you hear that?
Yeah, capital dried up.
Yep.
What's happening right now?
Same thing.
Capital's drying up.
Yep.
I just ran into a guy I met years ago, and we were talking, and he's now the CFO for a private equity firm. And I'm like, "Oh, how are you guys doing?" He goes, "We're great. We're in distressed debt." He
They're
goes,
into what?
They're in distressed debt. They buy distressed,
Oh, pennies on the dollar kind of stuff.
yep." And he said, "We're doing real well right now." I was like, "Well, it sounds like you're going to be doing pretty well really soon." Real
Well,
well.
it's I just bought some more treasuries today for 5.4%, and I'm not happy doing that. I don't have to worry about right now because this market to me is insanity. Now it may go up forever, but
Well,
history doesn't tell me that.
well, I think that when it'll go up based on liquidity, the availability of money to push it higher.
Right.
If we're in an environment where we have credit tightening, where banks are tightening, where mortgage rates are over 7, that's not going to fuel this market long term.
Well, I think a majority of those with money have stuck their money in treasuries and CDs right now until thinking the same thing we're thinking. When it all goes to hell, then I'll pull that out and I'll go
Hmm.
on a buying spree when it's on sale.
Yeah. Well, it's interesting. I think the smart money is that way. I think the big institutional money is more that way. It's not the retail investor. And I think it's like the guy I was talking to today was saying, he goes, when they get their, May statement, and he was referring to one Ameriprise guy who's moved everything to cash and gold, which I'm blown away he's able to do it. And the guy opens his statement and sees that he's actually down a little bit because gold has gone down in the last month or two. He's going to be talking to his friends and they're like, "Yeah, I'm up 15% for the month, you know,
For the
and
month, but how about for
he's going to get pissed, and he's going to go to his advisor and says, "Get me into this market." And to me, that is the indication of, okay, now we're at the top of this, because the retail investors are the dumb investor. He's the last guy. So it's a question of, if that's part of this whole thing, when does, most people get their statements on the 15th of the month, or quarterly statements. So it's middle of
yeah,
summer.
I don't know.
Yeah. Huh.
Yeah, I mean, again, it depends on where you are in your life.
Oh,
If you're a young
absolutely.
guy, but for me, I'm just holding on to if I can make 5, 6% right now, tax advantaged, and I'm okay with that,
Right.
because we just came off of 12 years of record, 10, 12% every year. I'll
Right.
take that. So now I'm only making half of what I made, and there's no risk.
Right. Yeah. Well, I don't know. I'm looking at this as this is that small sliver of your portfolio that, um, what's his name? Um, Michael Burry trade. This is the creative trade. This is the thing you start thinking about of what's happening. Where are we at?
Yeah, look how long it took him to, he was so far ahead, what, a year and a half ahead of that?
I think it was like, what was it? Paulson was ahead by 5 years. He took a beating for all that time.
Yeah.
Yeah, I think Burry was right behind. It was in that
Yep.
same range. Not that they were fully into that trade, 5 years earlier, but they were building into it. And as we got closer, they got bigger and bigger in it. This is, these are things I think about is like, what's the big macro pivot that generates my ability to go buy a house that is now 7 figures and I can go buy it at 3.
Yep.
That's sort of how I'm thinking of it. So I don't know. Cool.
You have here, let me share a screen.
Okay, hold on.
So I always, when I get like, man, this market's taken off, I go back, and this is 2 years ago. Can you see it?
Yeah.
This is the S&P.
Huh.
We got a ways to go.
Higher?
No, I mean, here, look right here. This is where we were at the heights, right back here.
Yeah.
47.96. Okay, around that area. 47, almost 4,800.
Right.
We're sitting at 42.73. So everyone's looking at this over here, saying, yeah, but we got a long way to go. I mean, seriously, if you would have bought here, you'd still be behind. You know?
Yeah.
And that's 2 years ago. You'd have bought here at the height, you'd have bought here at the height, you'd have bought here at the height, you'd be ahead. We finally broke a little bit above, and that's because of AI only. 7 stocks got us to this point right here.
Right.
And now we're bouncing off of 4,300.
Where does that match up? Okay, so we're back at what was that? September of 22.
This is August of 22 right here. Yeah, August right here.
Okay. Yep. So that's where we're at today.
Yep. So August of 22, we're almost, a year it took to get back to where we are now. But everyone thinks it's great. But how many of these people lost money here? And now they're just like, they sold out, bought back in, sold out, bought back in. That's what the market does to you. So with that mentality, here they are buying back in again.
Well, and you look at the amount of short, people who are short the S&P right now at this level. It's like, how much higher can it go? How much more money can be shorted against this to push it higher? And I guess that's where I look at this and go, okay, is this a pivot? And then, is that short interest going to get that phone call and say, listen, I didn't make any money last week or last month. You need to get me in this market. And it flips from a long or short to a long. And you get a little bit of pop.
Again, here's the NASDAQ.
Yeah.
We're at
similar thing.
14,414, and over here, we're at 16,380. So we just draw it over, and this is all AI related right here.
So it's not a broad thing.
It's not broad. This was more broad here. But again, buy in here, buy in here. And so I like it when they go back and say, oh, since the beginning of the year, the NASDAQ's up 30-some% or whatever. So that is right
there.
Right about here.
Yeah.
Okay. But what's it down from here?
Yeah. Well,
this was
so what was so that's 1,600 on the top, 1,660.
Yeah.
And what was the
high up here was around 16.6.
Okay. And then what is the bottom?
It would be right about here in the last 2 years.
And that's what?
10,440. No, 1103. Yeah, it was 10,440 was the bottom. It was the low.
Okay, so let's say half of that. Plus,
No, that was a year ago, October.
So it should be halfway would be right around 13,520. Where are we at now?
We're at 14,817.
What is it?
14,817.
So we're approaching probably a 60% retracement.
That'd be from October low.
That'd be from the October low.
Yep. Let's go look at the Dow Jones, which doesn't have all this. See what happened. There's 2 years on the Dow Jones.
Yeah.
Yeah, this was not so. I mean, it's
Right. So we're
let's see,
nearing.
we had a high right here at 36,799, and we are at 33,609. So 3,000 down.
What was the bottom? 28.5 or so?
Bottom
28,750?
Get it set here. The low here was 28,660. Let's see what this one here is. Oops. 28,725. So 28,6, 28,7. And today we're at 33.5.
So
The high
we're,
was 30. The high was 36.7.
so is it close to 10% off the highs?
At least, you know.
So we've retraced maybe, what is that, 85, 80,
Yeah, but
85%?
But it looks like to me, you know, right now we're going into lower highs and lower lows. Pretty
Yeah.
much.
Right?
Here's our high, here's our high, here's our high. You know, we have a little bit of an uptrend in the 9-day right here, but not much.
Yeah.
So anyway, you know, I always break it out and say, okay, that's good. We are moving up on some of these. Why is it moving up? And can it go back up as high as we had it all in one shot? I don't think so.
Yeah.